We're fortunate to be joined by Matthew Piepenburg, Commercial Director at Matterhorn Asset Management AG, Gold, Switzerland. Matt, thanks so much for joining us today, all the way from France.
That's great to be here, Adam. Looking forward to it.
Yeah, this is going to be fun. And Matt, you have been a highly requested guest on this channel, and so it's wonderful that you were able to
That's
finally
great.
join us here. Really appreciate you taking the time. Look, I've got a lot of questions here for you, a lot of them taken from your recent piece that you released a few days ago, which is pretty excellent. Before I jump into those specific questions, though, let me just start with a question I like to ask all the guests here at the beginning of the interview. What's your current assessment of the global economy and financial markets?
Baffled, cynical, concerned. I think the four-letter word that describes everything and what everything trickles down to is debt. How it will be sustained or not sustained, the mechanizations used to use lofty words to hide really, really bad math. And I think the lack of transparency and honesty about the ramifications of postponing a debt crisis with more debt, which is just monetized with literally money printed out of thin air that's not linked to an asset, a chaperone, or a service. And so all these things, from inflation to recession to quantitative easing, quantitative tightening, disinflation, currency risk, bond risk, risk asset market risk, equity risk, it all flows down from debt, and debt all flows down from our policymakers, not just at the Fed, but globally, but in particular at the ECB, the Fed, the Bank of England, the Bank of Japan. It is phenomenally risky, and it's based on a monetary theory, which I think has bought us some prosperity and some euphoria, but will end with a hell of a hangover.
All right. You echo Lacey Hunt, former senior economist of the Federal Reserve, who we've had on this channel often. In fact, we just had him keynote our online conference about a week and a half ago. And Lacey has basically said, look, yes, we're all distracted by this inflation problem we have right now, and we need to get that under control. But we had what seemed like an almost unsolvable debt problem before it arrived, and now that's even worse. And as soon as we get inflation under control, we're going to have to, get real about what's going on with debt again. As I hear you talk, I'm reminded of the title of a Kevin Costner movie. We found out, Matt, that you and I went to college around the same time. In fact, we went to the same college.
Yeah.
And around that time, Kevin Costner was in a movie called No Way Out. And I'm curious, if you had to sort of put a movie title on the debt situation, is there a more optimistic one than No Way Out? Or is this basically a hole that we're not going to get out of, at least not without, some sort of massive reset?
What was that other movie, Hangover? It was another series with, yeah, there's no way out other than a massive hangover that we've postponed. I've used that analogy. There's many different analogies: can kicking, hangover, martinis, keg parties. But we've been enjoying years of a fantastic frat party provided by instant liquidity when needed, whenever there was a hiccup. And we've avoided any hangover by constantly providing Bloody Marys just as that hangover is starting to come. And I think a great movie title would be Hangover, because we're going to suffer a hell of a hangover. We've just been able to postpone it with optics and fiat money on demand and systemic liquidity, or excuse me, synthetic liquidity. And it's absolute fantasy. And it buys votes, it buys time, it even buys a Nobel Prize for Bernanke. It's absolute fiction to me. It's completely disingenuous and unsustainable. And again, it's not even tinfoil hat or sensational. We can get into the math of this. We'll talk about it, but the bond market is far more honest than a central banker or a politician, left, right, or center, or a governor of California or a mayor of Philadelphia or Chicago. The bond market is telling us what we want to hear. Unfortunately, the bond market is very boring. Looking at the implied volatility on the 2-year futures, or the yield on the 2-year or the 4-week treasury, or the 10-year long duration. No one wants to see this. I understand it's complicated, it's boring. It's actually fascinating when you look under it without too much complexity. I mean, a lot of people would rather watch Gwyneth Paltrow's trial about an ambulance chaser in Deer Valley because they don't want to see this, or they don't want to understand it. I understand how that's so boring, but it has massive ramifications for the quality of our life, and not just for political debate or pundit debate on different macro themes. It will and does hit the road. Eventually, it affects our lives. It affects our ability to take care of our families, to worry about our job security, to worry about our mortgages or our tuition. So these things seem esoteric and boring, and they need to be made less boring and more transparent and not weaponized or partisan or political. It just needs to be simple math. And when we get into that, which I hope we will, I hope, most of your viewers, obviously all your viewers are very informed, but it becomes mathematical rather than just pundit based or debatable. It's simply going to end badly. So yeah, there's a hangover coming and there is no way out. Reset, great reset, QE pivot, whatever you want to call it. It's going to need mouse click money to sustain our debt markets and to sustain our completely Fed driven equity and credit markets now. There's no natural price discovery. There's no natural supply and demand. The markets have been hijacked by a central bank years ago, and that's just what it is. The Fed actively manages our economy like a portfolio, but they're a bad portfolio manager. And they've bought time through leverage. They've bought time through lofty words and fancy diplomas and high position. But, if history isn't canceled in 20 years, our kids or grandkids will read about the most epic failure of monetary policy since 1971, really. And certainly since 1913, when the Fed was unimmaculately conceived and brought into law under the pressure that Woodrow Wilson didn't even want to sign by a bunch of banking cabals. So no, we're about to hit, serious karma. And, timing that is kind of a mug's game, but the math of it's fairly clear to me.
Okay. And let's get into that math. I love the fact that, you're saying, look, this isn't a partisan issue, but it's certainly, been made one. It's part of the whole political kabuki theater that goes on here. It's sort of the cycle that we're in, which is that the mugs running the system break it, and then they're the same people who come in to rescue it, and we're trapped in this, the sort of Groundhog Day. God, we're just coming up with all these movie titles here. But then at the end of the day, it's just not mathematically sustainable, and we need to really understand that. There's also an element in here that maybe at the end we can reflect on, which is I've opined at times that this is sort of a comment on the fact that we don't really teach financial literacy very well in this country, but that people we've sort of abdicated our agency as a society in the financial system and in matters economic. We just tell ourselves, "Ooh, math is hard, so we're just going to let these really smart people run the show." Right. And as you've said, they've kind of proven again and again that they're no mental giants here. In fact, they've got a pretty poor track record. But we just say, look, it's above our pay grade as regular people. And the answer is it's really not all that tough. The math isn't all that super complex. And we as a society just need to sort of get more involved, right? Absolutely. You're nodding as I'm saying this here. Okay, well, look, I want to share some of your words back with you here to give you a jumping off point. Again, they're from your excellent recent piece titled Je t'accuse, to bond killers and other villains destroying our world. Okay, so you're not pulling too many punches with the title like that. Here's what you say. As I look back on just the latest and entirely predictable hours, days, and weeks of waste occurring in the global debt markets in general, and the US Treasury markets and banking systems in particular, the billions and trillions sloshing and churning through emergency swap lines, discount windows, and broken financial systems almost defies belief. For the last 2 years, we've consistently shouted from the rooftops that, quote, the bond market was the thing, and that when it eventually broke, markets and innocent financial lives would tilt towards implosion, immediately followed by more centralized controls from the very policymakers who caused the crisis. And then you begin to you go through and say, look, I'm not talking about a coming bond crisis. It's already underway. You cite the 2019 repo market blowout there. The sovereign bond fall during the onset of the pandemic in 2020, the overnight collapse almost of the UK gilts market in 2022, which almost brought down their entire pension system, and then here in 2023, we're seeing the weaker banks, so far at least the weaker ones, really begin to buckle under the Fed's recent policy reversal here. So let's talk about this. The bond market really, credit is the lifeblood of the global economy. That's kind of the foundation that everything runs off of. And you're basically saying it's in the process of breakdown at this trajectory.
Yeah, it's an overused phrase, but the Fed can tighten into the greatest debt bubble for as long as they want until something breaks. I'd argue so many things have broken. As you mentioned, there's been 3 moments of complete dysfunction in the credit markets, which if people understood credit markets should have been headline coffee talk news every day. And that repo market was the first. The 2020 sovereign crisis was the second. The gilt implosion was the third. That was last year. And then early this year, we've already come into the first quarter, and now we're seeing this Silicon Valley Bank narrative, the Silvergate, Signature, First Republic, et cetera. They're all related. They're all things that have broken as we're raising rates into a debt bubble. When you raise the cost of debt, when debt is the rotten wind beneath the wings of this so-called post-2008 recovery, when you hit record high debt levels to sustain record high stock, bond, and real estate bubbles, and then when you hit that by keeping rates repressed for years and printing money to the tune of billions a month, when you reverse that policy, things start to break. And of course, something broke. We can talk about Silicon Valley Bank. To me, it's just a metaphor. It has nothing to do really with a 2008 parallel. It rhymes, but it's very different. But my point is the Fed has put itself in a corner. They can either raise rates and destroy markets, banks, credit markets, equity markets. Equity markets follow the debt markets because equity markets depend on rolling over cheap debt and buying their own stocks at low rates. Those games are over in a rising rate environment. Powell has ended that charade, but at the same time as he's trying to fight inflation, he's going to get a Pyrrhic victory, looking over the rubble of credit markets, equity markets, and economies, and of course, smaller regional banks. But it really does have a ripple effect into the Main Street economy too, not just depositors at small banks. And so, something has broken. I think it's significant. It's more of a narrative about how year after year, headline after headline, another thing breaks because our bond markets are so vulnerable. And the Fed and the politicos, left or right, some more vociferous than others, will try to deny this with lofty words, kind of like be calm, carry on during the Blitz in London or World War II. Lots of lofty language to hide really, really dangerous math. Again, 31 trillion in public debt, 90 plus trillion in combined household, public, and corporate debt. That's become an aberration. And I said in that article, it's like Hannah Arendt's book, The Banality of Evil, talking about the Holocaust. When you're talking about millions of lives, it almost becomes a banalized, abstract. And even for the people at the time, they kind of turn their head, or even in history, it's hard to kind of conceive of those kind of numbers. Is the joke, if I owe you $1 million, it's my problem. If I owe you $1 billion, it's nobody's problem. It's your problem because no one's going to pay it. These numbers become abstract. When you're talking about 31 trillion, and by the end of this year, probably 34 trillion in public debt, which we don't have the GDP or the tax receipts to pay for. And we'll, of course, we'll have to monetize that debt by printing money in some form, in some way, mechanized, artificial. It's an abstraction. It's a banality of mathematical and debt evil. It's a banality of currency evil. It's a banality of trillions and billions that mean nothing to anyone anymore. They just kind of assume we have a debt ceiling, we have a bond crisis, we have an IOU. We'll pay for that with a mouse click at the Eccles building. That works only for so long until you see cracks in the ice. We've seen those prior cracks, the repo market, the gilt markets, now the regional banks. I think what we're seeing now is how many more cracks until the ice breaks beneath our feet and we have a bigger problem, which can only be solved by either some artificial reset, a global Chapter 11, or more likely, as Yellen's been hinting all of last year, despite Powell's chest puffing, a pause in the aggressive rate hikes and a return to the only solution we have, because Ponzi schemes can't taper. And that may sound like a massive simplification, but what we have as monetary policy, and this is something David Stockman said years ago, is effectively a Ponzi scheme. That's not an exaggeration. You can talk about Sam Bankman-Fried, or you can talk about Bernie Madoff, or you can talk about Bernanke, Powell, Yellen, and Greenspan, because what they do is they issue IOUs for which they don't have the money. We don't have the GDP, the tax receipts, the productivity, the income to pay for those IOUs. And when the proverbial X hits the fan, their last resort is always going to the Fed, mouse clicking a few extra zeros when needed to pay for those debts. Believe me, if Sam Bankman-Fried or Bernie Madoff or any sticky-fingered hedge fund manager who would otherwise be corruptly put in prison had a money printer in their basement, which they could legally use, they would use it. Who wouldn't? It's addictive. And, again, remember, Bernanke promised us back in 2010, QE1 was going to be temporary with no consequences. This is just a temporary solution for bank crisis. just like Powell told us last year that, inflation was going to be temporary. They have to use words to deny the math. And again, this goes to the theme of who do you listen to? Do you listen to what Powell says, or you listen to what the bond market says? When Powell raises rates, when rates go up, bond prices go down and yields go up. And that's what happened in Silicon Valley Bank. We won't get into the weeds of it, but basically their long duration treasuries lost value. Across the entire banking system, anyone holding long duration treasuries lost $2 trillion in market value on the collateral, those treasuries, which are considered risk-free return. But when measured against inflation, it's return-free risk. And so these policies, these measures by Powell have ramifications. They throttle the bond market, they throttle the banking market. But let's keep in mind also last year, 2022, all this talk about what a brave Volcker reborn superstar Powell is going to be. Remember, Volcker raised rates in the 80s or late 70s when our national debt was less than $1 trillion. It was 800 billion, 900 billion at the hot. We're at 31 trillion. So we can't afford to raise the cost of that debt when our debt is infinitely higher than it was in the Volcker era. So for Powell to pretend to be Volcker is frankly disingenuous.
Right.
But,
and sorry to interrupt, but it's also more than 4 times what it was just going into the global financial crisis.
Just going into, exactly. So we're talking about math that doesn't make sense if you just look at the simple balance sheets. And what did Powell achieve? He reduced the balance sheet by 300 billion. After all that talk last year, all this QT that so shocked the markets, the S&P, the NASDAQ, the credit markets got shellacked last year. S&P down 15, the tech, NASDAQ down 30%, credit markets down. We had the worst nominal returns in stocks and bonds in 2022, nominal together. These are correlated assets. They were supposed to be hedged. They're correlated now. Stocks and bonds, worst nominal return since 1871, just past our Civil War. So that proved that that little reduction in the balance sheet, which was 300 billion, which by the way, just in the last few weeks, we've already lost that 300 billion in loans to these regional banks and FDIC extensions. So all the work that we got for QT last year, well, we saw the reaction in the bond and stock market. A 2% reduction in the Fed balance sheet caused massive ripple effects in our credit and equity markets. And frankly, all the quote unquote money that we tightened is already back in the system. So there is a major thirst for liquidity, a major thirst for collateral in the banks, a major need to support the treasury market naturally. It can't be done naturally. There is no natural demand for Uncle Sam's unloved IOUs. And so regardless of what Powell does this quarter or last quarter, regardless of what the FOMC meetings or the Brookings Institute or even what they say in Jackson Hole, the net result is if no one else is buying our debt, who's going to buy it? It's simple, but it's going to have to be a central bank near you. And again, if we don't, the consequences are going to be dramatic in our economy. They're already dramatic in our banking system. We can go into that. But if we do pivot and instantly liquidify the treasury markets and therefore the banking markets, the bond markets, the repo markets, the Eurodollar markets, all these different exchanges, even the derivative markets for which treasuries are collateral, all these things rely on liquid treasuries. If we liquidify them through mouse click money, we have the inevitable inflation or possibly hyperinflation. People talk about inflation. There are real issues about the war, about COVID, about supply chain links, but let's just keep it simple, stupid. We raised the M2 money supply by 14 trillion over the last decade plus. That's why we have inflation. It's very simple. If I hand you a glass of good Bordeaux wine and we put a swimming pool of money into that glass of wine, the wine loses its flavor, just like our currency has lost its punch. It may be relatively stronger than all the other patients in the ICU. It's still a sick patient. It's still the inherent purchasing power of that currency, like every other currency, has lost so much value when measured against real assets that it's openly obvious. And again, these things are not transparently discussed, Adam. These are boring things about currency risk, about yields on bonds, about supporting those bonds through printed money or mouse click money. How much is 31 trillion versus 35 trillion, or 900, a $9 trillion Fed balance sheet versus a $4 trillion balance sheet? They're just abstractions. And if you saw Yellen recently in front of the Senate, it was embarrassing. I was almost embarrassed for Yellen, how little she understood about the extension of the deficit, the rising of the deficit this year. She didn't even have the numbers in front of her, and she's the Treasury Secretary and a former Fed chair. So again, when push comes to shove, when you're asked to look at hard numbers, even our experts don't even fully grasp them. And certainly the average person, through no fault of their own, has, I think, less and less understanding. I think more and more so now, hopefully. But for years it was just trust the experts. I think that trust, like trust in just about everything, whether it's the media, politics, social identity politics, partisan politics, left versus right media, trust in so many things is palpably changing right now in the U.S. and certainly here in Europe. It's a major loss of trust, and that also has invisible, hard to quantify ramifications too.
Right. And I was thinking maybe we get to this in a bit, but let's touch on it briefly right now. In many ways, you may be getting a preview of what's still yet to come to American shores, right? Because there's a lot of protests and just general civil unrest breaking out, not just in France, but kind of in all places around Europe, right?
Oh, sure. I mean, obviously, I've lived in France for over 20 years. There's never a season in France where there's not a strike somewhere, whether it's on the trains or on the highways or in the cities. But, right now there's a major social unrest in Paris in particular about extending the legal age for retirement from 60 to 62 to 64. There's concerns about pension risk. There's concerns about currency risk. It's a very political unrest, but it all boils down to money. And pension risk, which smarter folks than me, including Michael Burry or Raoul Powell or David Stockman, I've written about in a book about pension fund risk, but that's real in Europe just as much as it is in the US. And this goes to a theme that was in the article that you mentioned, which you're right. Most of the time I talk about boring things like bond spreads or volatility in the bond market or 3 sigma moves that we saw in US Treasury and 2-year treasuries. A 3 sigma move, according to MIT scholars, should happen once every 50 million years.
Yeah, isn't that crazy?
It's crazy, and that just came out by a Bloomberg, Dan Ingles. And then the spikes in the volatility in the 2-year treasury, we haven't seen that since. It was worse than 2008. It was worse than 9/11. It was worse than 1987. The volatility, and I used to be a bond trader, and I've talked to bond traders this week. You couldn't get a bid or an ask because the prices were moving so quickly, 60, 50, 70 bips. When you're talking about moving millions and there's 70 bip moves, that makes the market too volatile to trade. You're looking at moments of real illiquidity, which again, we haven't seen since 2008, 9/11, 1987, and yet not really discussed in the headlines, not making front page news. I joke, it's Gwyneth Paltrow ski accident, not bond market 2-year yields. Understandably, Gwyneth Paltrow ski accident's a lot more interesting than 2-year yield volatility. But when you actually see what that volatility means and what it's pointing toward, again, the bond market and the bond traders, and even if you look at something as boring as euro dollar futures, they're pricing in a major pivot at the end of this year. They're seeing interest rates coming down because there's going to be an oh shit moment, pardon my French. There's going to be an uh-oh moment. We can use that as a better word, an uh-oh moment in the bond market. And so the market jocks, the bond jocks they're already pricing this in. Powell won't talk about it, but they know what we all know is it's not sustainable. There's going to need to be magical money to support Uncle Sam's IOUs, and therefore you're seeing this massive spike in the contract price of euro dollar futures. Again, very boring stuff, but what it really just says is there's no confidence in our bond market. There's no confidence in our Fed policy. There's no confidence in our currency ultimately, and so these things have to be known so people can prepare. And I think, and be informed. I don't have an easy answer. Powell doesn't have an easy answer. We can talk about asset classes.
I don't think there are. That's what we're going to get into here. But that's sort of why I started with no way out. Like there is no painless, graceful way to change your behavior and go to something better. We're going to have this hangover that you're talking about.
Yep.
Right?
Unfortunately. Yeah.
So, Matt, you this is great. You're identifying a ton of paths I want to try to take this conversation down. So to me, you nailed it with this quote, which is that Ponzi schemes can't taper, right? So you were just talking about confidence, right? Like every Ponzi scheme is a confidence game, right? It runs on confidence. When confidence runs out, that's when it implodes, right? So, the challenge the Fed is getting into is the cost of continuing the Ponzi is now threatening to be as big as the cost of stopping the Ponzi, right? He's kind of trapped between the inflation dragon and the
recession,
the system, the systemic instability dragon, right? So, but I asked you about the I don't know what you want to call them, riots, demonstrations, protests, whatever,
social unrest
right now, because that is. So, people, I say this a lot on this channel, people, there's 2 ways to change. You can do it proactively, right? You can project out mentally where things are going and say, oh, if I continue this behavior, it's going to eventually have a bad outcome. Let me start today before things get really bad, right? Being human beings, we hardly ever do that, right? We just continue the status quo until the pain of continuing it outweighs the pain of changing, right? So that's the guy whose doctors told him, you got to get in better shape, buddy. The guy says, yeah, I'll do that someday. And he doesn't until he has the first heart attack, right? And then he's like, oh, okay, right? So, all these manifestations of the civil anger and stuff like that, those are the signs of the system saying the status quo is getting too painful to continue. You're right. I'm sure most of those protesters don't really understand central bank policy. They don't understand the Eurodollar futures market or whatever. But what they know is, wait a minute, just prosperity wise, I'm being diminished here to a point now where it really hurts. And I need to get out there and say that this is no longer working for me. Right. So I think we're going to see more of those symptoms break out around the world as people just dawn that, like, oh, well, I want to go buy some eggs, but Jesus Christ, they're just, I can't afford them anymore. Right.
Yeah. You don't need to be an economist or a pundit or a former hedge fund guy or an executive in Switzerland in real assets to know that when your purchasing power is disintegrating, when inflation is hitting you, especially at the middle class level, something's wrong, something feels off. And then frustration, stress, anxiety, employment concerns, all of those things snowball. And I think this is something I've said it many times that, again, it's not an opinion. It's historically confirmed that every debt crisis throughout history, every debt crisis ends in a market crisis, which ends in a currency crisis, which then leads to social unrest. And at the end, ultimately, it leads to extreme control from the political left or the right, extreme centralization. When we could talk about that in the banking sector, in our social lives, in our private lives, central bank digital currency, they're all symptoms. We're seeing a tilt towards more and more centralization and control. And social unrest is always a symptom. And I used to think in college that economics was not nearly as interesting as history or philosophy or psychology and understanding the movements of history. It's great or bad men and women who affect history. It's great or bad philosophical movements. But I realized, at least from experience, that something as banal and boring as economics and inflation and mathematical events really move history. If you look at inflation,
they drive everything. They're what all those people react to.
Right, exactly. And so they're all connected. They're all very important. They're all ultimately human, all too human, because it affects our personal safety, our sense of security, our sense of trust. Chairman Mao came in after inflation. Napoleon came in after the National Assembly blew out the French currency in 1789. Hitler, Mussolini, and Franco came in after inflation in the 30s in Europe. Almost all of Latin America's regime changes and horrific stories from Argentina to Peru to Venezuela always happen in periods of inflation. So inflation does matter. Monetary policy does matter. Reckless, drunk driving of our currency and financial system and our banking system through centralized controls, which Andrew Jackson and Thomas Jefferson and Ludwig von Mises warned of, always kills the currency, which always creates to inflation. I even quoted Hemingway. You can go from Thomas Jefferson to Ernest Hemingway. Every time you destroy the currency system, you buy short-term prosperity and ultimate ruin. And part of that ruin, he said three things. This is Hemingway, not a Fed chair, not a politician, fairly bright guy, fairly brave guy, fairly troubled guy, who spent a couple of times in 2 world wars. He said, you have inflation, you have currency debasement, and you have war. We're seeing that play out in real time right now. And, it's whether you're Hemingway or Powell, you have to understand the power of math. And I think, again, many people are starting to figure that out. They don't need to understand Eurodollar futures. They just know something feels wrong. Our debt's wrong. There's too much control. There's too many excuses. They don't know who to believe anymore because the media, like our currency and our Fed and our policies, are so weaponized now that people have a hard time even trusting me. You must be selling your book. It must be gold, a gold bug. Again, I understand that. That debate, that open discourse, which I'd love to see more of. You remember the days of Gore Vidal and William Buckley, two very different views, but brilliant, articulate, impassioned, honest men trying to debate facts. What we have now are a lot of social justice warriors or a lot of angry, emotional people debating emotions. They're not looking at the facts. We've seen a death of facts.
In TikTok-sized sound bites too.
In small attention spans. Yeah. And so I think the more we can get facts, unadulterated, nonpartisan, or at least intelligently debated, including views I might have. I love a debate. I would love to see someone give me better news than I'm providing. And rather than try to beat that person in a debate, I lean into the table, I listen. I'm trying to look for good news or rays of hope. I just don't see it right now. So the best we can do is prepare financially, psychologically, cynically for the ramifications of reckless driving, really since Greenspan came into office. I could see him the patient zero of this, but it really is since the Fed was created and since central banks, took over our markets. As Rothschild said, give me a central bank and the power to control money. I control the world.
Right.
You control money.
And the shift to purely fiat currency as well in that journey. Right.
Yeah, exactly. Yeah.
All right. Well, look, so it sounds like, to steal Hemingway's words there, that what you're worried about in terms of sort of where this ends is currency debasement, inflation, and war. And I know you're looking for better news than that, and I'd sure love to hear it too. But I think what you're saying is, like, it's just prudent for those of us who have studied history or are studying the markets, can project things out mathematically, that those things are uncomfortably high from a probability standpoint. And so we should be taking steps today to at least say, okay, if they happen, what can I do now to be less vulnerable to them? And we can talk in a bit about sort of, you're a capital manager, so we can talk about how you are trying to manage capital in this type of world. But before that, so to your point about the Ponzi schemes can't taper, right? From everything you've said, it doesn't sound to me like you see a way that the Fed can find a way to magically avoid all of this, right? At some point, it's faced with the choice of, I'm going to die by fire or die by ice here, right?
Adam. You said, what's my first thought for the world economy? And my answer was debt, right? And so the Fed, like the ECB or the Bank of England or the Bank of Japan, or look, Powell, for example, because of all this debt surrounding him that his institution has helped build, because you can't solve a debt crisis with more debt. 2008 debt crisis, solution, more debt paid for with printed money. He's like a kind of a blind man walking through a powder keg with a candle in his hand, hoping not to hit anything and blow it up, and trying to walk a very fine line with QE, QT, raising rates to have something to lower, optically talk about controlling inflation. Maybe we'll have a higher target inflation. Maybe we'll just misreport inflation, all kinds of tricks and gains. We all know on Wall Street that the CPI scale, I always joke, is as bogus as a 42nd Street Rolex. We all know that it's bogus. It's much higher. If we use the scale that Volcker used, we're at much higher inflation than reported. They can play with maybe a higher target inflation rate. They can play with even unemployment statistics. Nick Eberstadt has done a great job of showing the fiction behind our employment data and the fiction behind our CPI data. And these, again, this is not sensational. It's not tinfoil hatted. I've got no horse in that game. It's just trying to be as candid as I can. Again, happy to be challenged. But we all are thirsty for blunt, open, honest math right now. And so, what can we do? And what will Powell do? He has very little options. He is walking through a powder keg of debt with a candle, and he doesn't have good options.
And his corridor is narrowing and narrowing, and the piles of open gunpowder are higher and higher. Yeah, exactly.
Yes.
So that's where I wanted to go here, just to sort of ask you to pontificate here, and nobody knows, right? So you're more than welcome anytime you want to come back on and give us an update as events develop from here, Matt, giving you that open invite. But what do you think is the end game here? Right. At some point, the central banks are not going to be able to, lie, cheat, or steal, a way to kick the can further down the road. And so maybe two unfair questions to ask you to pontificate on. One is, how does this break, do you think? Do they think they eventually choose the hyperinflation or the route that leads to high inflation and currency destruction because it's always the politically palatable one in the moment itself? Or do we have a Volcker moment or something like that where we just try to break the system? And it's going to get bad, but then we can build atop the rubble when the dust settles and do something more sane going forward. And sorry to make this such a long question, but do you have any sort of gut feel on the timeline of this, right? In other words, like, is this going to be the rest of our lifetimes that we're going to be just sort of sloshing through all this, and guys like you and I who are in our 50s are probably not going to see the new dawn? Or is this something that might happen a lot faster?
Yeah, I mean, there's a lot in those questions, and I'll try and really be specific in the answer. In terms of what to expect, again, You drink 20 martinis, you will have a hangover. You swim way out past the big surf without a surfboard or a leash, you're probably going to drown. If you if you play with too many weapons with no training, you're going to get injured. And at this point, there is no solution to the debt unless we pivot at some point. And it's not a question of Q2, Q3, or Q4. The Fed will pivot when we have another '08 or another March of 2020. Remember, 2020, we printed more money in a period of 12 months than we did in the prior 8 years. That was not a market recovery. That was a counterfeit solution to a real problem, which was openly inflationary and hidden behind a lot of bad math. But Powell, I think, thinks he can be Volcker, but he also isn't stupid. He knows he's really raising rates right now, so he has something to lower when the recession that they denied, that they redefined, becomes too hard to deny, inevitable. I think we're either in a recession now or clearly on the border of one. But that even won't be enough for him to pause. What will happen, I think, is we'll see it where the pain is always most visible and making the most headlines. When you see it like an '08 moment or a 36% drop in March of 2020, which would have been 50, 60, 70% drop had they not printed trillions in a matter of weeks and months. That was appalling. And behind the scenes of the COVID crisis and the PPL checks and the stimmy checks and all that, what we really saw was a backdoor, another 2008 bailout of the bond market. That, again, not making the headlines. It was, I won't get into conspiracy theory whether they engineered COVID or whether they exploited a crisis to benefit, but it really was just another bailout, because no one wants to see another too big to fail bank or corrupt bond market or banking practices or Wall Street get bailed out again. Nothing better than to try and sneak that bail in and that kind of trillions in liquidity than a humanitarian crisis like COVID, which, again, smarter people than me, pro or con, can debate about the sincerity or insincerity of the COVID narrative, but it was a backdoor bailout. So to your question, I think what the Fed will do right now, Powell, I think, needs negative real rates and inflation to inflate away debt. He'll optically pretend to fight inflation, but you can't fight 6 or 9 or 10% inflation with 5 or 6% interest rates. What he's really doing is raising rates so he has something to lower when there is a recession or a market crash. He tried that in 2018. We have short memories. Throughout 2018, they tried to tighten and raise rates throughout 2018. I was in the south of France at Cannes on Christmas Eve. It was a disaster. Markets tanked. By 2019. We went into a pause and a pivot. Markets and the bond markets and the stock markets can't handle rising rates. Eventually something breaks. So to your point, what will happen? Something will break more than Silicon Valley Bank. Something will break bigger than First Republic or Silvergate, which are appalling for other reasons. We're talking about a major disinflationary move in the risk asset markets. When that happens, Powell will reach into the only tools he has, which is more money printing and more rate reduction, and that will be inherently inflationary. The solution, it's a doom loop. It's a doom loop. The solution is always going to be synthetic money on demand, which is inherently inflationary. So he's trying to fight inflation. Can't do it. Can't do it. If you really wanted to do it, it'd be like any family. I say this all the time. You and your wife sit down, honey, we can't put our kids at Choate. It's too expensive. Can't buy the Porsche. Too expensive. We have to tighten our belts. We can't live on a Visa, MasterCard, and an Amex and your mother's help. We have to tighten our belts. We have to face austerity. We have to focus on productivity. We have to get better jobs, better income. That's what every American has to do in real time, because we don't have money printers in our basement. But our government won't do this. I had a long conversation with Grant Williams about this, the lack of responsibility and accountability. The Fed will always blame, war, viruses, extraneous events when the mirror is right in front of them. It's very simple who's to blame for this. There's no accountability. I find that criminal almost, if not super unethical. But again, they're politicians. They need spin. They won't take accountability. When was the last time any of us saw a central banker say, maybe that extra $8 trillion on the Fed balance sheet was a bad idea? Maybe modern monetary theory, which was a fringe concept when you and I were in college or grad school, is now mainstream. It's an absolute fairy tale. Anyone knows this. A 10-year-old would know if you explained it, that you can solve a problem by creating money out of nowhere and paying for it with no actual value. So, at some point the narrative breaks, but, they're in a doom loop. They'll print. The other option, of course, Adam, is they could do a reset, a global Chapter 11. I'm not talking about a Klaus Schwab type of reset. But if you may or may not have noticed, I wrote about this in 2020. It was so obvious, like a cavity to a dentist. They were exploiting the COVID crisis. The IMF did it first, then the Bank of International Settlements, then the Fed. But they were already telegraphing, almost like a PSYOP, like a CIA program. They were already telegraphing in 2020, in the height of the COVID crisis, that COVID was like World War II. This is a debt crisis we haven't seen since World War II. And we need to come together and think about maybe a centralized digital currency or some way to monetize this debt that's not our fault. God knows it's not our fault, not the big banks. And they were comparing COVID, which wasn't pleasant for any of us for a lot of different reasons, a lot of different cynical reasons. But to compare COVID to World War II is an insult, certainly to a European American or anyone who lives overseas, where 80 million people died in cities like Rotterdam, London, Frankfurt, Dresden, obliterated all of the Ukraine, Russia, the Crimea, death like you can't imagine. You cannot compare World War II, economically or human terms, to COVID, no matter what you think of COVID. For the IMF to do that, to kind of plant that comparison, to create that fear, to justify, again, no accountability for central bank policy, blaming it on some virus, or now, of course, Putin, very debatable issue, Putin, Zelensky, whatever, we won't get into the weeds of that, but there's always someone else to blame. When it's so simple, it's right in front of you. It's money printing gone wild, which is what David Stockman warned about long before COVID, long before Putin, long before supply chain disruptions. It's very simple. You're adding buckets of water to a glass of wine, you're killing the currency, you're creating inflation, and you're hurting people, and you're creating social unrest and distrust. And so when there's distrust, they have to create some kind of new fear narrative so there's no one blames them. Because the biggest fear of any corrupt leadership, left, right, or center, is people being informed and aware of how
is
much
accountability.
Is accountability. Yeah. Imagine that.
Yeah. And what's what sort of makes this sort of a vicious cycle, right, is, they create these problems, as you're saying, and they do everything to deflect, their own responsibility and role in it. But when the symptoms of the problem really emerge at full strength, the populace says, well, then give me more stimulus, right? We're still at the point where we're asking for more alcohol, right, from the overgenerous bartender, right? Yeah. So yes, they need to embrace austerity. We're increasingly having to just be forced to embrace it because the cost of living and our real wages are still going down. Mm-hmm. But what we're asking for, right, is more profligacy. And I think that I put the blame with the central planners. I understand why the person trying to put food on the table is asking for help here. Yeah. But until we have sort of a realization in the shift that, like some form of austerity, living within our means, is really what we're going to need to have a long-term sustainable, better tomorrow out of all this. Until we stop asking for these guys to do what they're doing, we're probably just going to get more of the problem, I guess is what I'm saying.
Yeah, that's a very good point. It's easy to point the finger at people like Powell or Bernanke or Yellen or Greenspan, and it's true they deserve it. But we all also ourselves got addicted to easy money. I saw it in the 90s or in the NASDAQ bubble and the post-08 bubble. I saw it leading up to the subprime crisis. Who doesn't like a handout? Who doesn't like low rates? What markets don't? Low rates give us rising markets, and rising rates give us low markets. You can go long or short based on a simple trend indicator or the yield on the 10-year. But you're right. We all love a tailwind. And when the Fed is giving you one, giving you instant liquidity, giving the economy the liquidity it needs to sustain itself, we're all suddenly experts in stocks and bonds or digital currencies or whatever sexy trend is of the month or the week. And yet we get addicted to that as well. So it creates a moral hazard at every level, understandably. I think it's fine if the average retail investor wants to take advantage of a tailwind. And part of the reasons we have these conversations is to warn them, though, that these tailwinds have very dangerous turning points. Yeah. And if no one can time a market, you can get caught in short squeezes, you can get long vol. It can be very scary, but you got to kind of know when you're near a top and near a bottom. No one buys at the bottom and sells at the top. It's always the opposite, but we're all clearly near a top. Question is, how do you prepare for that in your portfolio, or what assets are safe? And that's a whole other conversation too. But yes, the moral hazard is not just on small banks like, or depositors like SVB, or big banks like the central bank or the BIS. The moral hazard affects investors across the board, sophisticated, unsophisticated. We get used to this keg party. We don't want it to end. So give us more. We can make fun of Powell, but we've all profited from him as well, right? To some extent. And so that's a very good point, Adam.
Yeah, I mean, every investor, or not every, but most investors there are rooting for the pivot. Oh, great, we're going to go back to the way it was, right? And then stocks go up every year, and I just buy the dip, right? And I can throw a dart.
Well, it's funny that that was a bank term funding program that kind of came out during the Silicon Valley thing. It was nothing like TARP, but the joke was what was the BTFP? They were calling it buy the freaking pivot. That's what the signal was. And that's what the Eurodollar people are saying. It's not next week, tomorrow, but the markets are pricing in a pivot. Again, markets know more than what Powell is going to say. And I think that's an important point.
Great. And let me just ask you about that. So you said that, look, at some point, something's going to break somewhere, and that's what's going to force Powell to pivot. So the market is pricing in a pivot this year. It's pricing in several rate cuts this year. Does that mean that the market is expecting something systemic to break badly enough to force Powell's hand there? And if it is, then why are stocks still where they are right now? Why are they not getting repriced downwards? Because presumably some systemic break like that is not bullish.
No, I mean, but that goes to the moral hazard. First of all, many investors are just stuck in passive risk parity portfolios that somebody on the corner or online runs for them. It's mostly stock bond diversification. They're just riding this wave and they keep their head in the sand. And most advisors tell them, don't worry, if there's a correction, they always correct. They always bounce back. So just ride it. There's a lot of things wrong with that philosophy, but nevertheless, why are markets so high despite the fact that everyone's, everything looks so bad? Again, it is because there's a moral hazard that when things get really bad, the Fed will do what it has always done since 2008. At every dip, you could buy it. At every even major correction or a downturn, including March of 2020, there's nothing the Fed can't fix. So if you can bite a stick through even a 36% drawdown like we saw in March 2020, the Fed will save us. So we love and hate the Fed. And again, if they save us, that just means we're going to have hyperinflation. So the 20% you made on your S&P will be eaten alive in real terms by the inflation. It's running uphill in roller skates. But I think, again, this goes to memories are short and fantasy is long, and no one wants to think about sensational tinfoil hatted reality or math. But remember, again, you and I were teenagers, but when the Nikkei crashed in 89, or at that time in Japan, everyone thought, well, how can we get hurt if we're all crossing the road at the same time? We're in this together. We're going to be fine. Well, the Nikkei crashed in 1989. That was well over 30 years ago. It has not recovered its highs. Right. I'm not saying that we're going to have a Nikkei-like crash this year, although the markets are pricing in a major rate cut because they're pricing in a major market disaster. But right or wrong, remember, all bubbles pop. The last bubble to pop is always a currency bubble, without exception, period. Timing that is very hard. You got to look at the signals from the bond market. But assuming that all bubbles pop and the currencies are the last to pop, how could you prepare yourself? But Nikkei crashed over 30 years ago. If you were 70 over 30 years ago, you never got that money back. If you were 25, fine. You want to wait it out. So how you manage this risk, how you think about the future is very different depending on your personality, your age, your profile. But if we have a Nikkei-like crash, which we will unless we print more money and have hyperinflation, there's going to be a lot of people that are going to be very, very hurt. And that's where, again, the reality of the economy, the reality of your personal life actually becomes the real issue here, not bond spreads, indicators, Eurodollar futures, yield curves. It's just you don't have any purchasing power. You don't have a portfolio that was valued the same next year as it was last year. You don't know what to do. You don't know who to trust. You don't know what signals to look at. You don't know how to prepare. So you trust the drunk drivers at the wheel of the Fed, which has created a moral hazard that they can be trusted. And so far, since 2008, they've kept us above our nose, just above water or then some, created the greatest risk asset bubble I've ever studied or seen. And I've seen the NASDAQ bubble. I got a profit off that IPO. It made me a very independent man by accident. So I'm all in favor of bubbles, but you got to also know their dark side. And you got to also know, you got to think about that, again, there is no exception. All bubbles pop. The only way I think theoretically you could keep this bubble from popping is very simple. You monetize it with mouse click money, but that just creates a whole other set of problems with inflation. So technically you could have a market that never dies, deficits without tears, but you can't avoid the inflation. So pick your poison. A necessary austerity moment in the markets, or the absolute murder of the purchasing power of your currency, be it a euro, a dollar, a yen, a yuan, a franc, a peso. And we joke about banana republics in South America, Central America. America's balance sheet's it's a banana republic. We're just the world reserve currency. But eventually, and as we're seeing massive signals of de-dollarization and a whole other theme, even America, like Rome, like Mao, like China, like Napoleon, like the great powers of the 30s, even those empires collapse, always because of a debased currency, always. That, again, sounds sensational. Like, I get it, sounds crazy, or at least not in our time, but it's already happening. What Hemingway warned about, currency, inflation, war, isn't down the road. It's right now. It's already happening. It's just a matter of degree of how much worse it gets. You and I have no idea whether the war in the Ukraine escalates or not. That's out of our hands. 365 planes were just sent over. When we talk about Zelensky in the Crimea, it's not Zelensky, it's NATO. He doesn't have an air force. Let's call a duck a duck. This is not Ukraine against Russia. It is a proxy war against Russia. Whatever you think of it, I'm not going to get to that debate, but let's just be honest of what it is. Let's have an open debate. Again, same thing with markets. Unlike politics, though, markets are more honest. That's my point from the very beginning. The bond markets are more honest. The yields are more honest. You can track those regardless of what the Fed does. You can see the direction of the market by, how the bond markets and the asset classes react. And again, that doesn't make you perfect market timer, but it opens your eyes real fast. And again, without getting into the weeds of Silicon Valley Bank, at the end of the day, why didn't they go to a discount window? Why didn't they go to a dealer? Why didn't they take out a $90 million loan on $100 million worth of collateral? It's not about the banking risk. It's about the fact that no other banks wanted to help Silicon Valley Bank, and no discount windows would rent or loan against them, because the actual issue wasn't just long duration risk in their treasuries. The actual risk was their collateral, their loans.
Right.
Their loans are 30-year mortgages. Nobody wants them. That loan is a symbol of the economy. And that loan is no longer valuable because the Fed raised rates into a debt bubble and ruined the value of that long-term duration paper. So again, it's not about banks. It's not about loans. It's about the faith in the economy. It all trickles down to the economy. And that economy is where Mr. and Mrs. Smith, you, me, and everybody listening, that's where the real world is. Worrying about their portfolios, worrying about their job stability, worrying about their kids' education, worrying about the $10,000 in their checking account that may only buy worth $5,000 next year in terms of purchasing power. Those things are boring, but meaningful. They're not nearly as exciting as what's on Netflix tonight, but they affect our lives. And that's why the bond markets and history and cycles are important. They're not easy, but they're not that hard. And again, it doesn't mean take my opinion or my books or my articles. Look at other people's. But what's amazing now is there's a lot of consensus, whether it's Ray Dalio in the US or me in Switzerland, or whether it's Lacey Hunt or Daniel Martina Booth or Dave Stockman or good, intelligent, courageous journalists. They're all trying to say the same thing. And again, we're not saying we are the truth. We're saying we are honest about what we think. Right. And that's what's missing in the media. That's what's missing in politics. And that's certainly what's missing at the central bank. Honesty. Doesn't have to be genius. Just be blunt. Just be blunt. For God's sakes, just give us some real simple math. And that's what I'm driven by now, because it's so important to our lives right now. We're in a historical turning point right now. That is not an exaggeration. It's already in our lives in real time. So it's not even postulating or speculating. It's actually happening to us right now.
Well, you're preaching to the choir. That's actually a big part of the mission of why I created Wealthion in the first place, was to sort of have this platform for this kind of honest, fact-based dialogue. And of course, it only works if we get smart people like yourself who have the courage to come on and just say, hey, look, this is, I'm not going to sugarcoat it for you. This is just what it is, right?
Yeah.
So all the Mr. and Mrs. Smiths of Main Street that are watching this video right now and have listened to this interview, I'm sure are saying, whoa, okay, so that's a really challenging future that Matt has laid out for us here. What should we consider doing about it if we just don't want to become, unwitting collateral damage to what's coming? And of course, your day job is managing capital, and priority number one is preserving it. And then priority number two is trying to prudently grow it in this environment, if that's possible. How are you looking at, the decision-making and portfolio allocation in this environment?
Yeah, and this is where, again, and completely understandable, this is where the cynics will say, well, here comes the honest expert suddenly selling his book, and they're going to question that. And I need to be aware of that. I always say, my colleague Egon von Greyer's and I have been talking about gold for years, or precious metals, or real assets, or commodity cycles and portfolios. We're not trying to sell a book. We're selling conviction, or this is my opinion, and we'll talk about it. I'll answer the question, but I think it's important not to be cynical. It doesn't mean believe every word I say, but I could be at Goldman Sachs selling bonds for a fee. I don't want to do that. Most of us could be doing that, but I don't believe in those bonds. I didn't do that when I was managing funds, and I came to precious metals and real assets only because in this particular environment, you've got to own an asset that can't be printed or manufactured at will, that has a kind of an infinite infinite duration, but finite supply. And so, no, I'm not going to say just go out and buy gold, buy gold from us. It's not that simple. Gold is not sexy. It's not a speculation asset. I don't think it's the sexiest thing that every client or every person listening should be buying. I just see it as currency insurance for currencies that are already dying. And I'll just say it in real simple terms. When I was in high school, I played baseball. And if we had a really good pitcher or the other team had a really good pitcher, we knew who was going to win the game, who was pitching. We had to go play through the motions, 9 innings, 6 innings, looking at my watch, sitting on third base, waiting for the 7th. But if we had the right pitcher, we were going to win. And it's really hard to say in anything in the markets that you're certain of something. In fact, the only thing that worries me is just how certain I am. I don't know a lot of things. I can't time a market. I do know that since 1971, when Nixon took away the chaperone of gold from the currency, that since 1971, every major currency has lost at least 95% of its value when measured against a real asset like physical gold. Again, whether you believe in gold or not, just look at the math. There's all kinds of cycles and trends, and gold can go up and down. It's not Bitcoin, doesn't have a standard deviation of 170. I just know this. Like I knew I had a good pitcher or a bad pitcher. I'm going to win or I'm going to lose. I know that gold is going to ensure my purchasing power better than a yuan, a dollar, a peso, a franc, or a euro. That's all I know. That doesn't mean everyone should put everything they have in gold. My first thing is just, it's a mathematical fact that currencies have lost 95% of their value since we closed the gold window in 71. That's just objective fact. Doesn't talk about volatility and prices. I own gold like every one of our clients as insurance against banking risk and currency risk. It's just that simple. And I feel high conviction to say that. In terms of other things you can do, again, own assets that can't be printed at will by a corrupt central system. There's a lot of talk about Bitcoin or digital currencies. There's all kinds of risk, all kinds of greatness. The philosophy behind digital currencies, there are many who, I don't have to be a gold fanatic or gold bug, which I think is a cheap term for people who understand gold, but I don't have to be a gold bug and have to hate Bitcoin or other digital currencies. I think Bitcoin is a major existential threat to the powers that be for a lot of good reasons. And that's why I think there's risk in it. But there's certainly arguments to be made that Bitcoin is another alternative currency to an openly dying fiat world. I think Bitcoin is coming under a lot of pressure from central bank digital currencies, power politics, et cetera. I have no interest or desire to see Bitcoin investors get hurt. I'd love to see them make more money. I'm jealous of them. I wish I had bought it at $10 like everyone else. But I worry about the volatility and the long-term use of it, but I would be thrilled to see Bitcoin succeed. I worry that they are a real threat, though, to the powers that be and to this trend towards central bank digital currency.
And therefore has a target on its back?
Oh, absolutely. It's too smart. It's smarter than the Fed. That's the problem. Bitcoin is too smart. And there's other problems, but that's the main problem. But that's a high-class problem, but it still has risk for investors. The other thing I would say, getting away from real assets, and again, it's not just gold and silver. I'll send you a chart after this, and you can put it up there. It's probably the most important chart of the decade. It was provided by a good friend of ours, Ronnie Sturfalo. He's an advisor at Matterhorn. He's wrote the In Gold We Trust report. He's one of the smartest guys out there.
That's an amazing annual report he puts out.
Yeah, it's brilliant. He's brilliant. He's modest and humble, but he's absolute genius, and he certainly knows the real asset space. I'll send you a graph. He called the most important graph in the decade. And it's just the commodity cycles. Again, buy low, sell high. Get out of asset bubbles, get out of fiat currencies, get out of tops, and think longer term, not month to month, day to day, quarter to quarter. And when I send you this chart, it's just simple, stupid. You get at the bottom of a commodity super cycle. That's where you want to be if you're an investor, as opposed to a trader. If you're a trader, you have your own signals, you have your own volatility, you have your long shorts, you have your options, you have your Kelter bands, your Bollinger bands. If someone's a trader, that's a different conversation. But for investors who don't have time to learn everything it is about being a professional trader, just buy low and sell high. Get out of assets that are overpriced. Get out of risky assets. Get into solid, boring things that preserve purchasing power, and get into at least have some portion of your portfolio in the commodity cycle that's going to be maybe painful in the short term, but is trending clearly up into the north. That's my advice. I would also recommend to people that are listening, talk to their advisors. Most advisors are consensus thinkers because they can group together in a bull market and then blame extraneous events in a bear market on something that they didn't see. I'm very cynical about the standard RIAs. I've seen too many. I've seen too many hedge fund managers that I've invested in that were full of whatever. But I think I would really, really start to question the risk parity portfolio, whether that's 60-40, 70-30. As we've been warning for years, stocks and bonds are no longer hedged assets, they're correlated assets. So that what worked for our fathers and grandfathers, or even us prior to 2008, those type of portfolios are only good in a tailwind. They're absolutely brutal in a headwind. They correlate to zero. And so your bond market won't save you. Your bond allocations won't save you. As we saw from junk bond to investment grade last year in 2022, just a horrible performance of the bond market at the same time that, equity markets were getting crushed. Again, should have been a headline. Worst nominal returns in stocks and bonds since 1871. The volatility in the last couple of weeks in the treasury market, worst since 2000, since 9/11, 2001, September 11th, 9/11. That was a pretty big headline, 9/11.
Mm-hmm.
But the markets were volatile then. Markets were volatile in 2008. Markets were volatile in the flash crash of 87. And yet, just last week, none of that stuff made the headlines in the mainstream media. Among pundits and among bond traders and among folks like us, we talk about it. But again, people would rather watch Netflix. But what happened at Silicon Valley Bank wasn't 9/11. But what the market says is, uh-oh. And again, we saw that in the repo crisis. We saw it in the gilt crisis. We saw it in 2000. There's been so many I told you so's that when and if, and I think short of printing trillions more, which is inherently inflationary, when and if we have another moment, no one listening, including us, can say we didn't know better. That's it. You don't have to agree. But I think the warning signs are there. And one thing I've learned, having made and lost money in my life, and I've done both brilliantly, I've lost more than I made many times. The way to be rich is not to lose money. It is not to lose your wealth. Wealth preservation, Egon says it over and over. It's not just a phrase. It's a way of life. You make money by not losing money. Every time I invest in a hedge fund manager, I didn't invest in the ones who told me all I was going to make, what the prognosis was, what the projections were. I always listened to the manager who said, these are the risks I'm worried about first. This is where you can lose money. This is where I see risk in my portfolio. They were honest. They were thinking more about risk than reward. Because everyone looks great in a tailwind. Everyone looks smart when they're on the trend. But the real smart money always is thinking risk first, not reward. Always looking like a lawyer. What's gonna get me? Like that famous line in The Big Short. Where are you gonna screw me?
Right.
Using, and I think people need to think more defensively and think 30 years out, not 3 weeks out. And be cynical. And by the way, again, don't trust everything I'm saying or anyone else that you interview, but put it all together. Think for yourself. Consensus thinking is almost gone today in America. Any kind of consensus view of reality and everything, again, politics, media, entertainment, social justice warriors, cancel culture, woke culture, based, biased, whatever. There's so much mess that it's hard to trust anyone. I get it, but I think try critical thinking, look at math, draw your own conclusions, look at not just graphs, look at history, listen to people you agree with and disagree with, including gold, including silver, including hard assets, including cryptos, but be critical thinking, take a little time. And your viewers already do that. That's why they're here. But I think the sad part is the vast majority of Americans trust too much or don't look enough at what's going on, trust their leaders. And that doesn't make them stupid. They're trusting people. But sadly, they're not critically thinking enough, or they're not cynical enough as they could be when it comes to their portfolios. And some people don't even have portfolios. They just have checkings accounts with money in there. And that's the saddest of all, because inflation is eating away at that every day. It's an invisible tax. It always hurts the poor more than the upper class. That's history, sadly. They're always the plankton for Wall Street's whales, always the first to get drafted and the first to get hit in a downturn.
Always the plankton for Wall Street's whales. That's such a great line. I hate the fact that it's so spot on. Matt, this has been wonderful. I literally could go on for another couple hours with you, and I'm sure people are going to be screaming in the comments, Adam, why didn't you? But I promised you a certain amount of time, and you already generously gone way over it. In beginning to wrap up here, Matt, for folks that have really enjoyed this discussion, and perhaps this might be their first real introduction to you, where can they go to follow you and your work?
Yeah, it's an easy URL. Egon von Greyer's and I are writing articles every week on goldswitzerland.com. Very simple, goldswitzerland.com. The name of our enterprise is Matterhorn Asset Management, and we only deal exclusively in physical precious metals, gold and silver primarily, stored in the safest vault in the world. It's like a James Bond movie. You got to see it. It's hidden deep in the Swiss Alps. Most of the gold we buy is direct from the refiners. 70% of the gold in the world is refined in Switzerland. And so we get the highest quality gold. But I think far more smart and important than Egon and I is we have this huge staff behind us that brokers and transports and does logistics and holds the gold in a truly safe way outside of the banking system. Because for years, Egon was way ahead of this. We never trusted the banking system, whether that was Lehman or Credit Suisse, small banks in Switzerland or small banks in Silicon Valley. We've always been, I think, prescient and distrusting the major commercial banks and currency risk and political risk. So you have to hold, I think, physical gold outside of your own jurisdiction, but in a safe private vault. And the counterparty risk is always the vault, so it has to be a good vault. And what Egon put together decades ago is really, I think, we think it's the best way to hold gold outside of the big commercial banks. And I would never hold my gold at a major commercial bank. And that's a whole other story. But yeah, so it's just Gold Switzerland, and we're called Matterhorn Asset Management.
Okay, great. And when we edit this, Matt, I'll put up the URL to Gold Switzerland there, so folks know exactly where to go. We'll put a link in the description to below this.
Thanks. Mm-hmm.
All right. Well, look, Matt, this has been fantastic. I just want to do a couple quick housekeeping notes as we say goodbye to folks here. You did a really good job. You're going to end up getting some sort of fruit basket or spiff from the financial advisors that Wealthion endorses, because these guys are sort of exactly of the type that you were saying you should look for in an advisor, which is they prioritize risk management first. Yeah, right. Yeah. It's all about, okay, first, do no harm by trying not to lose anything. And then what can I potentially prudently do on top of that? Folks, if you've listened to this interview, Matt has just explained why this is such a challenging time for investors, particularly the independent, regular retail investor here. And so highly recommend, as I always do, most people, especially if you've got real lives that demand your attention and you can't be watching all these swirling storm clouds that Matt's talking about, that you find a good financial advisor, good professional financial advisor who takes into account all of these macro issues that Matt's been talking about, uses those to create a personalized, portfolio strategy for you, but then actually helps you execute it as, the shoes are dropping along the path here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or if you'd like a second opinion from one who does, just schedule a free consultation with one of the financial advisors that Wealthion endorses. Just go to wealthion.com, fill out the short form there. It's totally free, no commitment to work with these guys. It's just a public service they offer. Like Matt, they're just trying to help people make decisions to position themselves more prudently now in advance of what's likely coming, all the things that Matt talked about. Secondly, just a reminder, if you missed our online conference from a week and a half ago where we had Lacey Hunt and a bunch of those other greats like Danielle DiMartino Booth and Stephanie Pomboy and Michael Pinto and Rick Rule and a lot of the names that Matt mentioned here earlier, don't worry if you missed it. You can still buy a replay video of the entire event, all the presentations, all the live Q&A by going to wealthion.com/conference. And if you've enjoyed having Matt on this program half as much as I had, and Matt, it's been wonderful. I'm very serious about you having an open invitation to come back on this program anytime you want. So folks, if you'd like to see that, please support this program by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Matt, this has been an absolute joy, even though we talked about some heavy things. Thank you so much for coming on.
Adam, it was my pleasure. It really was. Thanks. I talk a lot, but I hope it was helpful.